You've seen these very tight spreads. People have not really been concerned about the bond market. You're seeing now a severe movement in the stock market. You can ask the question, what is riskier right now, high yield bonds or the stock market that people have been following into for so long?
Yeah, I mean, notwithstanding what happened in Switzerland with the AT1 market, obviously, if you're an equity investor, you're at the bottom of the cap stack. I don't think many people are talking about the sort of large cap defaults that make you worried about that reality if you have been investing in Magnificent Seven or much of the large cap indices. But again, I think what's been forgotten in this whole conversation recently is just the risks that one is running and the compensation that one is receiving for those. So when you see a 10-year Treasury yield which is higher than the earnings yield on the S&P 500, that's telling you that there is no equity risk premium and you are paying through the nose to invest in a riskier security. And that's not a bad thing if you're at a stage of the cycle where you can expect growth to remain robust or to accelerate. But all of the conditions that would describe the end of the cycle have been in place now for a number of months. Unemployment has been steadily rising. And investors, I think, have continued to choose to believe that a soft landing is the likely outcome, merely because it suits the positions that they're running, not really because there is solid evidence or solid historical analogues for that.
You know, it's interesting when you see the morning's jobs numbers come out and it become weaker than many economists had expected here. Danielle, you've been warning of kind of the bifurcation of the consumer, but how much worse do things get now that we're starting to see a more significant weakening of the labor market?
Yeah, look, the numbers were weaker today. We're not macro forecasters, but it wasn't particularly surprising to us, just given that we have seen divergences in the data from the establishment and household surveys. We've seen downward revisions to the establishment data before, and this is overall a trend that we've been eyeing for some time. I agree with James. Equities need growth to work. And today in credit, you can get such a high income from high quality paper that you're being kind of paid to wait and be conservative. There could be more dislocation in the market ahead. It's a good idea in a portfolio to have some cash or some short duration investment grade paper that you can sell in a time of a dislocation. But generally, we're in an environment where we want to wait and see, and we want to prioritize credit selection and active management.